Thank you, everyone. Tom, thanks for being here.
Thank you for having me.
Okay. So first question. It's been obviously a pretty wild market. It's been your call that the bottom is in. Obviously, you've been right so far. You've been on media explaining why that is, some of the signs that you've seen sort of over the past several consecutive trading sessions as to why you believe that the bottom is in. But for the audience here, could you kind of recap those evidences that you see?
You know, we are in an unusual time because this tariff war has created a lot of uncertainty with businesses and consumers and trade partners and, of course, the stock market. And markets went into a free fall decline from April 2nd to April 5th, so a 1-week period. And I think everyone's been struggling to understand whether or not the selling has gone too far. But we have seen some things that only happen after or near a low. And I've been detailing them in our research, but among those that are worth noting is one, we have seen stocks recover 50% of their losses. So that might be the most important thing, and that came last Friday. Because in the last 14 declines of more than 20%, 21 of the 22 never retested the lows after recovering half of the decline. So that's important. So when you can bounce back to get half of your losses back, it almost never goes to a new low. But the other things that we have seen, some of them are technical, like a Zweig breadth thrust, which is basically a 10-day moving average of advancers. That broke above 0.6. We had 2 consecutive days of 90% advancers. That's usually always happening after the low. And I think maybe one of the more important ones is that the high yield market, which is a leading indicator for equities, managed to recover again 50% of its losses. So when that happens, that generally helps stocks confirm the low.
Just for clarification, when you say two consecutive days of 90%
advancers,
so 90%, like it's a breadth indicator.
Yes, it means, and they don't have to be back-to-back days, but it means on 2 different days, 90% of the stocks in the index rose.
Right.
So 2 consecutive days of 90%
And that's
advancing.
SPX.
Yeah.
Yeah, got it. I think the median 52-week decline for the S&P 500 companies is something like 18% or 19% the last time I checked. Are they still down too much?
Oh, well, I mean, you mean stock, can they recover?
Right.
Well, I think stocks can recover really based on 2026.
Okay.
So the most important thing to ask is, investors are going to try to focus on the next month or two and say, oh, well, the news is going to be bad. But that's not how equity markets work. Equity markets are thinking about 6 to 12 months ahead. And the real question is, are the tariff negotiations going to lead to a roadmap where 2026 earnings could be better than expected? And I think that that's possible. And if that's possible, stocks have a lot of upside. I think that if you're trying to look at stocks and decide to buy it every day based on the news coming out that day, you're making a big mistake. That would have kept you in cash since April 2nd.
Right. So 2026 earnings could be better than expected. Sort of please take us there, how the current policies lead to that.
Well, you don't want to get too specific because there is a multi-fork roadmap ahead of us. We don't know what the tariff roadmap looks like, but I think the important thing to think about is, what has the market been thinking about? I think the market has been thinking about the downside risks, and they've been talking about the risk of a recession or a trade war with China that leads to economic Armageddon. That is why investors only think about the downside. The flip side of all this is that the US actually has a lot of upside for exports, a lot of upside for deregulation, a lot of upside for changing tax policy, incentives for creating investment in the US, And all of that would actually not only expand PE, but also expand earnings. So I think you don't want to get too specific, because at the end of the day, if investors have raised, if cash on the sidelines is $7 trillion and investment sentiment is persistently negative, you don't have to be right. The market just has to be wrong.
How do you assess the risk of a recession? A lot of people are talking about, or a lot of these companies, we know that businesses have been asking for clarity, for instance. A lot of companies are reporting that companies are giving two different versions of guidance, for example, because they don't know. And naturally, uncertainty creates sort of pause, wait and see approach.
Yeah.
How much time do we have until that starts to affect the economy negatively?
Yeah. Well, I think maybe the way I'll start that is there's always a recession somewhere in the U.S. economy.
Sure.
Like in the last 5 years, I might even say 20% of parts of the U.S. economy have been in a recession.
Okay.
So that's why we call it a rolling recession. And the trade war is probably creating another set of rolling recessions. Now that doesn't mean the overall economy is in a recession, because GDP could just grow slowly as parts of the economy are in recession. I'll give you an example. Housing has been in a recession for 3 years now. And since 1900, prior to this period, whenever housing was in a recession, the overall economy was in a recession. But we've had a housing recession for 3 years, and the US economy has been fine. So the question I think we're all trying to debate is, if we have a trade war recession, so trade is slowing, is that enough to create an overall recession in the economy? Because we know it's creating a trade recession. And I don't have an answer to that. But the one market I'm watching is the high yield market. If high yield spreads, which means high yield rates relative to risk-free rates, if that reaches 1,000 basis points, then we're almost guaranteed a recession. But it's currently at 367 basis points. So to me, the high yield market is saying we have another rolling recession happening, not a US recession. So that's why I was asking you to clarify, because
Sure.
I think it's going to be too easy for people to say, oh, GM's in a recession, so the economy's in a recession. GM could go into a depression, and it probably wouldn't affect the US economy. But we don't want too many parts of the economy to go into a recession, because then that would drag the overall economy into a recession.
Right. The U.S. economy, and we've talked about this before, has changed a lot over the last several decades. Manufacturing is a much smaller part of the U.S. economy, and therefore we don't see recessions, broad-based recessions, as often. But even though we have these rolling recessions, the idea that we may not therefore have a broad-based recession implies that things are not really interdependent, but sectors, industries, aren't they even more interdependent?
Yeah, it's a good question. What you're asking is, if you have a rolling recession, why doesn't it pull everything into a recession at once?
Right.
And
at some point.
Yeah.
Yeah.
I think that that's possible, but historically it's required what you call a shock. So, for instance, if oil prices spike to $300 a barrel would cause oil to be 15% of US spending. That is a shock, because it's currently $50. But oil has to go up a lot. But in the past, that's caused a recession. The second type of recession is a financial system shock, like 2008. So if the financial system, the banks or credit, has a crisis, then that pulls all the sectors of the economy into a recession.
Right.
But if manufacturing's in a recession or housing, it doesn't create enough ripples. Just keep in mind that in 2023, when the regional banks got into trouble. Many people predicted a depression because they said, oh, the regional banks are going to be the firewall, and if they fail, all credit fails. But we had a regional bank crisis and the economy was fine.
I mean, I think the reason why, this topic of recession is potentially so sensitive is because, I saw some data recently. There was something like 18 drawdowns in the S&P 500 of greater than 15% since the 1950s. About half of it coincided with the recession. About half of it didn't.
Yeah.
But then when you see the severity of the drawdown when it comes with the recession is greater than the drawdowns that do not.
Yeah.
So this could mean, even though your view, it sounds like a broad-based recession is unlikely, that's not your base case. But if it does happen, do you see that actually causing a pretty bad market decline here in the U.S.?
Again, anything is possible.
Sure.
So people can't say they know anything with certainty.
Yeah.
But in 2022, we had a series of rolling recessions that have continued. So for 3 years now. And in 2022, the S&P was down 27%. And earnings didn't recover until the second half of 2023. Investors at that time claimed the market was going to have more downside because they thought the rolling recessions and the Fed tightening was going to lead to a bigger economic decline. We had argued strongly against that. We said that credit, the debt levels of consumers was too low to prevent a larger recession. Today, the same conditions are true. Businesses and consumers aren't highly levered. So there is risk of job loss coming, and that's why we could have a recession. But for someone to be so confident that we're going to have a recession, I think they're dead wrong. Sure. And by the way, that's what you're hearing. I think a lot of economists are declaring recession. In my 30 years, I've never seen an economist get the recession right. So the fact that many are claiming there's a recession probably tells me the odds are very low of a recession.
Got it.
We usually go into a recession and economists deny it, and we're already in a recession.
Yeah.
That's what happened in 2008.
Is your base case view that there will be sort of incrementally less globalization? And the reason why I ask that, which I recognize is a general question, the reason why I ask that is because if you look at the past couple of decades, there's been some great work done on sort of trying to the past couple of decades, S&P, what's been crucial to the S&P earnings growth, therefore the S&P return, has been margin expansion. Even excluding technology, manufacturing margins have expanded over the last couple of decades. A big chunk, not entirely, but a big chunk of that has been the direct effect of globalization by wage, lower cost of production, lower capital intensity, even tax treatments offshore. If that tailwind were to go away, doesn't that make a case for a lower or slower S&P earnings growth going forward and therefore lower equity returns?
I think people overgeneralize and people oversimplify the nature of margins.
Okay.
I can tell you definitively in 2008, I saw economists and strategists after strategists declare S&P margins after 2008 would permanently decline. And when I was at JP Morgan, we forcefully argued that margins would continue to expand because productivity and automation allow smart businesses to radically cut costs and re-engineer. And during COVID, we had many people chronically declare margins were going to fall because difficulty of unlocking supply chains. And then when the Fed began to raise interest rates, people forcefully declared margins would decline because as either inflation rose or fall, companies couldn't keep up. So in every single instance that people have declared margins would shrink, that has not been the case. Now, if someone's going to tell me that margins are going to fall because of this trade war, I'm going to say that they do not have history on their side. I think U.S. companies have proven time and again that they are able to manage costs. That is their strength. They are better at managing costs because they care about shareholder returns. That is not the case with other countries. And so I don't have an answer for that, but I'll just say that I'm hearing the same arguments I've heard for 15 years, and everyone's been dead wrong.
The current risk-reward setup of the U.S. market, how does that compare to, sort of in your experience, different prior risk-reward setups? Meaning, we've obviously had a pretty strong drawdown. We've recovered a lot of that. Who knows what's going to happen from here? But are there sort of prior episodes of drawdowns and recovery that this is the most analogous to?
Nothing seems to ever match the periods of time in history. Keep in mind, when stocks fell during COVID, that never happened.
Sure.
And we upgraded stocks on the day of the low with zero certainty of how we would get out of that COVID. But we knew the market had gone through a liquidation event. And nobody predicted that we would recover to all-time highs, but we did actually because of the size of the decline. And in October 2022, when the Fed was raising rates, there was no certainty that inflation would fall or what the Fed would do. So many people thought stocks would continue to fall, but we had declared that to be a low, and we thought stocks would recover quickly, which indeed was the case. But we had no visibility on the roadmap out. But what was the common thread? Companies were very good at managing costs and earning their way out of these, and I think that's going to be the case again.
Well, Tom, that's all the time we have today.
Yeah.
Thank you so much.
Thanks.